Turn your mind back to the summer of 2018. The headlines were screaming about a new Cold War. Every major news network was broadcasting the same story. America was finally standing up to China. We were told that the days of unchecked globalization were over. Tariffs were slapped on billions of dollars of goods. Politicians from both parties stood on podiums and promised to bring jobs home. They told you that the supply chains were decoupling. They told you that the economic marriage between Washington and Beijing was ending. And the vast majority of the American public believed them. It felt real. It looked real. But while you were watching the political theater, something else was happening in the shadows. Something that was never mentioned on the evening news. While the cameras focused on the trade war, the financial floodgates were quietly being opened. On June 1, 2018, exactly 1 month before the first major tariffs went into effect, a switch was flipped. It happened in the boardrooms of MSCI, the organization that controls the global investment indices. For the first time in history, they began adding Chinese domestic shares to their emerging markets index. This sounds technical, but its impact was seismic. It forced trillions of dollars of passive capital to flow directly into the Chinese market. Pension funds, 401 kiloseconds, and university endowments were contractually obligated to follow. And the giants of Wall Street did not hesitate. Between 2018 and 2020, during the absolute height of the trade war tensions, American financial exposure to China didn't shrink, it exploded. By the end of 2020, the total value of U.S. holdings in Chinese assets had climbed to over $1.2 trillion. Some estimates place the total exposure even higher, nearing $1.4 trillion. Think about that contradiction for a moment. At the exact moment you were being told to fear China, the smartest money in New York was buying China. At the exact moment politicians were preaching nationalism, capital was practicing internationalism. Why? Why would BlackRock, J.P. Morgan, and Goldman Sachs aggressively expand into a rival nation during a geopolitical crisis? Is it because they are traitors? Is it because they simply love communism? No, it is much simpler and much colder than that. They are following a mathematical algorithm. They are executing a survival strategy that has been used by the financial elite for over 300 years. They are not betting on China because they like it. They are betting on the mathematical end of the American dollar standard. They know something that the average citizen does not. They know that we are in stage 4 of the empire cycle, and in stage 4, the priority isn't patriotism. The priority is exiting the burning building before the roof collapses. Today, we are going to look past the headlines. We are going to ignore the political noise. We are going to look at the raw mechanics of how empires die. We will travel back to London in 1694. We will stand in Berlin in 1923. We will revisit Washington in 1971. And we'll prove to you that what is happening right now is not an accident. It is a pattern. And once you see the pattern, you will understand exactly why that money moved. And more importantly, you will know what you need to do to protect yourself. The mechanism of the trap. To understand the present, we must first understand the machine. Most people think of money as a constant. You think a dollar is a dollar. But in the timeline of history, money is a fluid concept. Every global reserve currency goes through a specific life cycle. It is born, it matures, it ages, and it dies. This cycle has 4 distinct stages. Stage 1 is the era of hard money. This is when a currency is backed by something physical, usually gold or silver. There is little debt, and the money is honest. You cannot print gold, so you cannot fake prosperity. Stage 2 is bureaucratic expansion. The empire grows. It needs to fund wars, colonies, and public works. So it begins to issue paper claims on the gold. As long as the economy grows, this works. People trust the paper because they believe the gold is there. Stage 3 is the turning point. It is the era of debt monetization. This happens when the empire's ambition outstrips its income. The cost of maintaining the military and the society becomes too high. Politicians are faced with a fatal choice. They can either raise taxes, which makes the public angry and leads to revolution, or they can print the money to pay the bills. They always choose the printing press. It is the path of least resistance. It allows them to promise everything to everyone without asking anyone to pay for it immediately. But this creates a mathematical trap. The more money they print, the more debt they accumulate. The more debt they accumulate, the more money they must print to pay the interest on that debt. It becomes a death spiral. And this leads us to stage 4. Stage 4 is the flight of capital. This is the terminal phase. It is when the people who run the system realize the system is broken. They see the mathematics. They see that the debt can never be repaid in real terms. They know that the only way out for the government is to destroy the currency. So, they begin to move their wealth. They move it out of the dying currency and into real assets. They move it out of the declining empire and into the rising one. They do this quietly. They do this while telling the public that everything is fine. And when the collapse finally comes, the middle class is left holding the worthless paper, while the elite are safely positioned in the next paradigm. This is not a theory. This is the recorded history of the last 3 centuries. Let's examine the first clear example. The London prototype. The year is 1694. England is exhausted. It has been fighting a brutal war with France. The treasury is empty. King William III needs money to pay his troops and build ships, but no one will lend to him. His credit is ruined. Enter a Scottish financier named William Patterson. He proposes a radical new idea. He will gather a group of wealthy merchants to loan the king £1.2 million. In exchange, the king will grant them a special charter. They will call themselves the Governor and Company of the Bank of England. But here was the trick. They didn't just lend the gold. They were given the legal right to issue paper notes against the government's debt. They created money out of thin air, backed by the promise of the king. It was the birth of the modern central banking system. At first, it worked like magic. Britain built the world's greatest navy. They colonized North America, India, and Australia. The British pound became the world's currency. As good as gold was the phrase they used. For 200 years, the sun never set on the British Empire. But the mechanism of debt never sleeps. By the early 20th century, the costs of maintaining this global empire had become suffocating. Then came World War I. Britain had to borrow massive amounts of money to survive. They borrowed from their own people, and they borrowed heavily from the United States. By the 1920s, the British Empire was effectively bankrupt, though few dared to say it out loud. The debt was astronomical. The industry was aging. And what did the British financial elite do? Did they keep all their wealth in British pounds? Did they double down on British government bonds? No. They looked across the Atlantic. They saw a new power rising. The United States was booming, had massive industrial capacity, abundant resources, and a young workforce. So, the British aristocracy quietly began to shift their capital, They invested in American railroads. They bought American steel stocks. They financed American factories. Families like the Morgans and the Rothschilds facilitated this massive transfer of wealth. By the time the British pound officially collapsed as the global reserve currency in 1931, the transition was already complete. The British public was devastated. Their savings were devalued. Their purchasing power evaporated. But the banking families who had engineered the system, they remained wealthy. They had successfully moved their capital from the dying host to the new host. They understood stage 4, the Weimar warning. But if you think the British decline was slow and gentle, let us look at a more violent example. Germany, 1923. The Weimar Republic. This is the most terrifying case study of what happens when a government chooses inflation over honesty. After losing World War I, Germany was crushed by debt. The Treaty of Versailles demanded 132 billion gold marks in reparations. It was an impossible sum. The German government had zero ability to pay this through taxes. So they turned to the Reichsbank. The man in charge was Rudolf Havenstein. He was a highly educated bureaucrat. He was not a madman. He believed he was saving the country. His theory was that by printing money to pay workers and fund the government, he could keep the economy moving. He thought he could print his way out of a solvency crisis. In early 1922, a German mark could still buy you something. By 1923, the printing presses were running 24 hours a day. The government was using newspaper presses to print money because the official mint couldn't keep up. We have all seen the photos. Children playing with stacks of cash like building blocks. Women burning banknotes in the stove because it was cheaper than buying firewood. But here is the detail that is often missed. The hyperinflation was not an accident of nature. It was a deliberate policy choice to wipe out the domestic debt. By inflating the currency to infinity, the government effectively erased its internal obligations. The debt remained the same number, but the money used to pay it became worthless. Who paid the price? The German middle class. The doctors, the lawyers, the teachers, the pensioners. Anyone who had played by the rules and saved their money in the bank was wiped out instantly. A lifetime of savings could not buy a loaf of bread. But did everyone lose everything? No. The industrialists, the savvy speculators, and the foreign banks made fortunes. They borrowed massive amounts of marks to buy hard assets, factories, land, foreign currencies. Then they paid back the loans with worthless paper dust. The smart money knew that the currency was doomed. They moved into assets that the government could not print. This is the brutal lesson of Weimar. Inflation is a transfer of wealth. It transfers wealth from the savers to the borrowers. It transfers wealth from the people to the government. And it transfers wealth from those who hold currency to those who hold assets. The American Twilight. Now, let us bring this machine to America. The date is August 15, 1971. Another Sunday evening address. President Richard Nixon interrupts the wildly popular show Bonanza. He announces that the United States is temporarily suspending the convertibility of the dollar into gold. He told the public it was to stop speculators. He told them it was to protect the American worker. But the reality was much simpler. The United States had printed more dollars than it had gold. The French knew it. The British knew it. Just days before Nixon's speech, the British ambassador had requested that $3 billion of British holdings be converted into gold. The U.S. Treasury didn't have it. The vault was effectively empty relative to the claims against it. So, Nixon closed the window. At that moment, the U.S. dollar became a pure fiat currency. It was no longer a claim on gold. It was a claim on the faith and credit of the United States government. For 50 years, that faith has held. But the mechanism of Stage 3 has been running the entire time. Since 1971, the U.S. national debt has exploded from roughly $400 billion to over $36 trillion. The dollar has lost over 98% of its value against gold. But until recently, there was no alternative. The world had to hold dollars because there was nowhere else to go. But now, we are seeing the signals of Stage 4, and this brings us back to that $1.4 trillion moving to China. Why did they do it? Look at the balance sheet of the United States today. In the fiscal year of 2024, for the first time in history, the U.S. government spent more on interest payments than it did on national defense. Let me repeat that. We are spending more to service our past debt than we are spending to defend our country. $882 billion in interest payments, eh? And that number is climbing every single day. This is the mathematical point of no return. When a government must borrow just to pay the interest on what it has already borrowed, the game is over. It is a Ponzi scheme, sanctioned by the state. The only way to keep it going is to print more money. And the only outcome of printing more money is the devaluation of the currency. The titans of Wall Street can read a balance sheet. They know that the US dollar is entering its terminal phase. They know that the next decade will be defined by inflation and currency debasement. So they are diversifying. They are doing exactly what the British elite did in the 1920s. They are buying a foothold in the next potential superpower. They pushed for the MSCI inclusion, not because they trust the Chinese Communist Party, but because they trust the diversification of risk. They are hedging their bets. They are buying real assets, commodities, and foreign stakes. They are building a lifeboat. Meanwhile, the average American investor is holding a portfolio full of government bonds and cash. They are holding the very assets that are guaranteed to lose value in Stage 4. The trade war headlines were a distraction. They kept you focused on the drama of tariffs while the institutional capital quietly exited the room. It is the classic magician's trick. Watch the right hand so you do not see what the left hand is doing. The left hand was moving $1.4 trillion to a safe harbor. The cost of ignorance. So, where does this leave us? It leaves us with a choice. We can continue to believe the official narrative. We can believe that the Federal Reserve has everything under control. We can believe that $36 trillion in debt is manageable. We can believe that inflation is just a temporary glitch. Or we can look at the pattern. We can look at 1694. We can look at 1923. We can look at 1971. And we can acknowledge the reality of the math. The system is designed to default through inflation. It is the only way the government can survive. They will not default openly. They will not tell you they cannot pay. They will simply pay you back in dollars that are worth half as much as they were yesterday. This is the hidden tax. This is why you feel poorer, even if your paycheck has gone up. This is why houses cost $1 million. This is why groceries cost double what they did 4 years ago. It is not just corporate greed. It is not just supply chains. It is the currency collapsing in real time. You are feeling the effects of Stage 4 every time you swipe your credit card. The question you have to ask yourself is this: if the most powerful financial institutions in the world are preparing for a post-dollar reality, why aren't you? If BlackRock is diversifying out of the American empire, why is your entire life savings tied to it? The window of opportunity is closing. The transfer of wealth is already underway. Those who understand the algo will position themselves to survive. Those who ignore it will be the liquidity that fuels the exit of the elite. The machine does not care about your politics. It does not care about your hopes. It only cares about the math. And right now, the math says it is time to move. But moving where? If cash is trash and bonds are a trap, what is real? Is it gold? Is it Bitcoin? Is it farmland? In our next report, we are going to open the playbook of the asset shield. We will break down the specific assets that have historically survived Stage 4 collapses. We will look at what the wealthy in Weimar Germany used to preserve their fortunes. And we will analyze what the modern smart money is accumulating right now while they sell you paper promises. You do not want to be left without a chair when the music stops. Subscribe and turn on notifications, because the music is already slowing down. I'll see you in the next video.